Hey traders, Nick Shaheen here, looking at a general video about charting. This is, I had a conversation with my friend Dave, and it was an epiphany. Okay, maybe this would benefit a whole bunch of people. All right, so charts can be misleading. You can see things that are not there. So how do I know what to use, when to use it, what time frame, etc. I have a few points that are important, so I'm going to try to use. Okay, so the market is open, so I have my eyeball on that too. All right, so here's Google. I drew these boxes today, and I'll tell you how I came to these boxes. All right, so this is a daily chart in Google. I'm going to delete them. Somebody asked me in the chat room, I forget what the question was. Oh, actually somebody made a comment. Google approaching 1200. So to me, that means nothing until I look at the chart. So I'm looking at the chart. Okay, it is approaching 1200, but that was 2 days ago also, which makes it an opportunity. So they tried to sell it off, and 2 days reversed the sell-off. Okay, so this is a daily daily chart. So every candle is 1 day. I can also see visually that this with the drop, that blue line, something that we charted. So when it was here, I probably said if it loses this level, it could go down to here. An eyeball that tells me it's back to halfway of that accident. So I'm looking at, let's see here if I can visualize it. There we go. So this was the up, this was the down, and somewhere in the middle lies the truth. So they're trying to come back to the middle, to where lies the truth. And this also matches up with the blue-red, which is a 1 year regression line, basically reverting to the mean. So everything makes sense, right? So an opportunity, sure. Usually when they come back from a bounce on a hard floor, they bust through it and they go up. So this is the daily chart, tells me that there is an opportunity. So number one, I am consistent when charting. This is TradingView, it's free. They do have pay levels, so look into it, but this charting concept works on any platform. Be consistent. Whatever you do it all the time so you get good at it. You don't play tennis lefty or righty every now and then. You consistently play with one hand. So know your thesis. So I know, meaning the macro and the micro. I know macro, we are at all-time highs as far as stocks, but the P&Ls are healthier thanks to tax cuts, etc. So it's valid. And Google is a healthy company within that macro. So the micro works with the macro. That's knowing the thesis. Spot the opportunity. We just did. They are bouncing off of a floor, and they could rally higher. And Google is a good company. It sells at about 51 PE, trailing PE, which sounds high. Give you an idea, Apple is in the 20s, early 20s, maybe 19. Facebook's 23. So, but it's a cranker. I mean, it's a growth company. It dominates 95% of all mobile search. So it is a good company from that perspective. I spot the opportunity. Learn the levels that matter. Okay, obviously, this level matters. And it's never a hard line in the sand. It's usually a rubber band. So 1200 matters. It's a round number, and it matters. But also, the one below it matters, which is 1160-ish, 5560. That matters. And obviously, this level area that failed also matters. So this upper zone. So know the levels. And usually it comes visually, becomes natural for you. And in fact, if I look left, the 1200, it mattered a lot for a long time. Boom, failed. Boom, failed. Failed, finally busted through it, failed. This would have been ideal if they use it as support going forward. But again, this is a zone. I would draw like a box here for the whole zone. It's consolidating in this zone. Not a big problem. So this is on the daily chart. Now, where it comes to, I think the better charters are people who change the time frames. So this is a daily chart. Usually I go to a weekly if I don't get enough clues from the daily to see where we're at. But in this case, I'm looking at an opportunity that's kind of shorter term. I go back to the daily, and I drill down. So I go down to a 4-hour chart. Boom. Immediately I see better levels if I go on a 2-hour chart. All right. So now it becomes clear to me that I need to first declutter, take out the volume. Okay. There's a whole other video about volumes. Okay, they matter. All right, so I see that this is an important part, that candle right there. So anything above that candle could bring buyers. And this technically now becomes a cup and handle-ish, not really because it dipped all the way down to here. But it is, you know, a push down by the bears that lasted long. Here it didn't even last but a V. So the bears may be getting tired trying to attack this level, and the bulls are getting comfortable defending it. So any breach of the last failure from the bulls probably has legs. Okay, where it stops again would be somewhere around here as far as resistance. So charting, I changed the time frames. Now I see things I didn't see at the bigger daily time frame. Let me see if I go down to a 60-minute chart. Yeah, about the same view. 30-minute chart, about the same view. So some people go to 15 or multiple views, so you see little gaps here and there. But for this intensive purposes of this breakout here at this candle is right the one that's important. So now I know that 1196-ish, let's call it 1196 and a half and above, would be a good place to chase Google for a short-term trade. So I can put an alert. So now if it goes above here, I'll get an email and a ping. Look at Google again, it might be breaking out. So this is the short-term trading. Longer-term trading, this would be a swing trade. So this is how I set up my charts. So again, we go be consistent, know your thesis, macro, micro, spot the opportunity, which we did, and then learn the levels that matter. And obviously this is the conclusion we got. Okay, this is the level that matters immediately. All right, now I'm going to zoom back out to 240 to draw that box. So I can draw this, I can tell that this box is important. They've been pinging back and forth between it. And a breach of either side, we just looked at the breach from here, would have legs. I'm going to draw it higher because I'm at a higher time frame. Usually it's going to be like tick, 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 tick. And then a loss of the prior floor probably will bring us down to here. Why here? That's a different conversation. I look left, that's where we consolidated last. Okay, so that's the box I deleted before we started this whole video. Okay, so use multiple time frames to spot different things. And sometimes your platform allows you to do things like, hold on for a second, taking multiple splices in time right away. What is this? This is Twitter. And look at this. We have a similar pattern in Twitter right there to the Google one. Cup and handle, inverse cup and handle, whatever. So this is multiple time frames on one. 5 minutes, 15 minutes, 30 minutes, an hour. So this is a short-term trading page. So I can immediately see things I probably wouldn't see on a daily chart, which is that candle matters. Okay. That candle matters, and it looks like an inverse head and shoulders of sword or cup and handle, whatever. It's a constant test of a neckline. If they breach the neckline, they go higher. Probably first resting point, second resting point. So you see the pattern there. I think I'm long Twitter and I shared it, but that's besides the point. So charting, again, we got to levels matter. We picked the level, multiple time frames. We just showed you why. Meaning, because why multiple time frames? I could be right on one time frame, but wrong with the trade because it doesn't fit the shorter time frame that come before I'm being right. So hopefully that makes sense. So now you see me talking about, which is the last piece of this video, is the technicals. You saw cup and handle, inverse cup and handle. Sounds fancy, but you know I've done many videos on that and many webinars on that. Stick with what works for you. So the easiest ones are trend lines. When a trend line breaks, usually it breaks down. Okay, cup and handle, just like what it is, cup and a handle. But really, they all are the same concept. Testing a neckline, and how they're testing the neckline tells you where they want to go with it. So if they're testing a neckline from higher lows, they keep bumping against this roof. Once the roof breaks, they're going to go up into the attic. Conversely, it may fall this way. So you have to read the prices going into it. You heard of head and shoulders, for example. They look like this. Again, testing a neckline. A rally that fails, bulls say, I could do it again. They do better than the first time, and then they fell back to the neckline, and they say, I can do it again, and they don't even match that. That means that they're getting tired, and the bulls, theirs are going to prevail, and if they lose this, they fall back that much. So learn a handful, which is what I've done, and use them consistently over and over and again. Don't fall into the habit of chasing a new technical indicator, MACD, or whatever. Whatever it is, pick a few, stick with them, and that's what I do. All right, Nick signing out. Hopefully this is a good base about charting.